All right, folks, welcome back. First of all, I want to thank you for your patience and not freaking out and sending me emails or tweets. Where's the lesson number 7, price action model supplementary lesson? You said it was going to be on the 30th. I was exhausted. I worked a lot this week for you all, and on the free member level, I just want to make sure I give my best effort to showcase how reading price and reading the tape, which is going to be the topic of this discussion, and how I can do that, in real time. So that was the point of the recording, so that way I can come back and tell you all in charter level some of the things that I did in those videos that you won't readily pull out. You'll look at what I'm doing and it won't make any sense. Like, it doesn't look like he's following any of his rules, and I am. It's just the chart on a 1 minute is skewed, and I'll explain in a moment what that means and how you overcome that, or at least how I overcome it. This is that 1 minute fractal that I traded, and I went long down in here and sold short up here, and then wrote it down into the equal lows here, getting out over here. And you guys already saw all that in the video. I want to talk a little bit about what I hinted at in the YouTube video that I posted this past week. And I dropped a little bit of a gem. And I didn't mean to do it, actually. I thought I was in a mentorship recording. But I'm glad that I said it so vaguely. It really went over top of everyone's head, I'm sure. They have no idea what I was talking about. But it's really important. So this is the part where I believe that folks like the quote-unquote professionals that say that there's noise on these lower intraday charts. It's not that it's noise. There's distortion. Admittedly, I will grant them that, but that's not noise. Okay? I want to build a short little bit of a foundation as to why this lesson is so important. When I first started trading, it was during the open outcry markets. That means when we traded the markets, we would call our broker with a push button or rotary. Actually, I had a rotary phone when I was trading. So that means you would put your finger in a little hole, spin it around on the face of the phone, let go of it, and it would spin back. Yeah, that's what I was trading with. But usually the only touch-tone phone I had was when I was on a pay phone stopping in the middle of my route to do any kind of trades or adjust my stop. So the procedure was this. I had a little Quotrek machine that I carried around, which was bigger than a smartphone today. And it had a little aerial antenna, like an old radio. You would telescopically pull it out. And I had it more or less duct taped, with a makeshift mount on my delivery truck windshield. So I would look at it like we would look at a GPS unit today in modern time. I was constantly looking at the bond market and the S&P market. And if I was in a currency or a grain market, I'd have that quote up there too. And I would be constantly watching it. What I was doing was teaching myself, without myself knowing, how to read the tape. And when I say reading the tape, what does that mean? It's a skill set that once you understand it, you can literally trade off of the ticker tape on CNBC? Yeah, CNBC. It was FNC when I was coming up as a trader, but now today it's called CNBC. And every 10 minutes at the bottom of the ticker tape, the futures market will give you the updated where it's trading right now. And you can literally watch this every 10 minutes and write down where the highest high and the lowest low you saw quoted. And then you would just keep track of that. Okay? On the floor traders back then, when we would call in our order, we would call our broker, wait for the order desk to pick up, and then we would say what trading desk we would be on. Like I would be on H desk at Lind Waldock. So they would answer the phone, hello, Lind Waldock, how can I help you? H desk, please. Hold for one moment. Boop. They put you over to the H desk. H desk, can I have your order? Right away to business. They don't like, how you doing? Nothing like that. Can I have your order? And you have to tell them, like, I want to buy 5 December SPOOs at whatever price or at the market with a stop at this and limit order this and good till cancel. That means the order's good forever. Okay. Or if you just know it's going to be today's order, you would just say, it's only for today. It's day order only. They would say, okay, hold for your fill. If it was a market order, if you say like buy me now or sell me now, and you tell them I'll hold for confirmation, they say, okay, hold for 1 second. They put you on hold. Okay, sir, we've sold 5 December SPOOs at blah, 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 the price. And here's your order number. Any other orders? No, sir. All right. Thank you very much. That's it. You're done. That was the process. Okay. You guys are all spoiled. Okay. You can get on and click and click and click and you're done. We had to, the whole time the market's moving around, we're trying to get a hold of someone before they could even do all the processes of getting us in or adjusting our stop or, getting out. All that stuff was going on at the same time. So it was important to know what the markets were doing from a tape reading standpoint, because when markets started to run, I wanted to be getting out. That way I had time. If I'm in a long and S&P were rallying and I was catching 2.5 points, and that sounds silly now today because of volatility, but 2.5 points or 3 points in a morning session, like that was it. Like you were getting, that's the full daily range. Anything above 3 or 4 was like crazy volatility, and it was moving a lot. But we were making careers on that little bit of a movement. That's okay. But nonetheless, once the move started taking place and I was in a long and it was rallying up, I was calling my broker if I felt that I needed to be getting out of it, which at that time was a lot, because once I got profit on my open position, I'd freak out and want to take my profit because I was a new trader. But I learned that wanting to get out when the markets are moving in my favor, it presented me time to find a phone, call it, wait for the order desk, trade desk, the guy to confirm, and then once I'm out of the marketplace. That's all time. And the whole time, the market's moving. So that was one of the things that taught me how to exit like I do and look for liquidity, because in the beginning, I didn't understand where liquidity pools were, where the market would be drawn to. I was just trying to get out while it was moving in my favor because of that condition of having to trade with that huge time impediment, where it was just too much of a barrier to get beyond if you were scalping or day trading and not sitting by some kind of a quote machine. And even though I had it, I was driving around through the Baltimore, Washington area on a delivery truck trying to do all that stuff. So what you watched me do this week, plate spinning and annotating charts before it happens in real time, I'm used to that level of nuts, okay? Because I was doing that as a route delivery driver, filling machines, soda machines, giving people back their refund, and I'm looking at my quote track the whole time thinking, I got to call this broker, and this woman wants her $1.50 back because it got stuck in the machine or whatever. I mean, it was nuts, okay? So what tape reading, what was the result of doing all those types of things? I ended up becoming a good tape reader and talking with real floor traders from the bond pit and the SPOOs pit, S&P market. I had the privilege to meet real traders on the floor, and they more or less explained to me how they did this. And I'm going to explain it to you, but you're going to be able to see it graphically. Okay, and it'll make a lot more sense. Many times you'll see me put in examples on Twitter, and I'll say, hey, like, what do you see? Do you see the market maker sell model? Do you see the market maker buy model? And invariably, everyone has their boxes painted on in different places, and it doesn't make any sense. Okay, what they're trying to do is just make something look similar to the overall model, so that way I'll either like that tweet or I'll comment on it. And I generally try to avoid it because most of the time they're drawing it wrong. And I'm going to show you what it looks like right now. And this is the actual 1 minute chart. And then what tape reading does, it gives you clarity. Okay. So it's going to require a little bit of on-screen photoshopping. Okay. And what? Your heart just skipped a beat. I knew it. ICT's a photoshopper. But I was trying to figure out how I can communicate this to you and show it to you in a visual representation of what goes on in my mind. So it's going to make a whole lot more sense to you. Just trust me. Come along with me. But in the meanwhile, everyone should be able to see the consolidation here. Okay, we had the original consolidation. We had the displacement. Come back into the order block. Fill in this BISI. Buy it. Buy stops above here. Run. Boom. Get out. Sell short. The draw was this level, as I mentioned in the review just a little while ago, same day today, August 31st, 2019. You'll see that that's a fair value gap up here on cable. Okay, so just watch the recording of the market review on August 31st, 2019. If you're seeing this video later on, that's what this level is. Okay, so I don't want to drive too much more information around it than what's necessary, because I don't want the video to be already longer than it needs to be. So using the market maker sell model, you could be a buyer on the buy side of the curve, buying it here and distributing your long and looking to go short at the smart money reversal. Low risk sell is over here. Now, where in all of this are you going to draw your box for the distribution cycle? The little red boxes that usually get painted on before they run down and take out the equal lows. Where do you draw that in all this? You see what makes it confusing, don't you? This is the part that people like at Goldman Sachs and UBS and all the other guys that are quote-unquote institutional traders, they don't have the visibility because they're looking at depth of market, they're looking at other things, okay, and they're looking at their own order flow coming into their desks. I'm going to show you what really is going on from an interbank level today, okay? So forget time. Forget that for a minute. I'm going to ring that in a moment, but think about the range, the price range itself. That's what I'm monitoring, okay? When price ran up from this level here to here, it did so in less than 10 minutes because each one of these candles is 1 minute candle. This imbalance, and it runs up into that consequent encroachment, also inside of the area where on this, let me put the vertical line in here so you can just see it. This is the highest point. See it? There's the highest point in the run up. So in this market maker sell model, all of this is on the buy side of the curve. Smart money reversal after hits a PD array or a premium array in the form of the fair value gap, as I mentioned in the market review for August 31st, 2019. Look at the cable portion of that video, and that'll unlock what this level is here. Then we have distribution on the downside. We wait. What are we doing? We're waiting to sell short. Well, I sold short right in here, knowing that this is likely to be a turning point, not coming back up to this level here because that would be what everyone else expects that thinks they understand order blocks. Look at this down close candle right in here. It's not likely to expand outside of this down close candle. Let me show you what that looks like. So as I'm watching price in cable this particular day, I know that this buy side of the curve, this is a point at which they're going to mitigate on the left side of the smart money reversal. Remember, all of this is pricing in just to go lower. That's the market maker sell model. So price action model number 7 focuses on the sell side expansion of this model. I zeroed right on that point right there because it was inside of this range, and it's the consequent encroachment of this single down close candle. Midpoint inside of this range here, because everything we move back up into this candle here, there should be selling here. In this area, between these two candles bodies, there should be selling off in there too. But where is it in here? Like this, you can understand using this candle, we're carrying it all the way to the other side of the curve on the model. So we're carrying that area of previous buying. They took it down below it, so now they're going to mitigate. They need to mitigate in here. So anything short they're on and they're offside, they have to get off of it. As it runs up, that gives IPTA gives them a chance to get out of their long and now go short, offering liquidity as a counterparty for the new market participants that are trading at the market right now. Or there may be transactions that are coming in from a commerce level, a business, global entity, Microsoft, Adobe, some country that's working internationally. They're going to move their order in based on this area here. But they're going to try to price that transaction unless the customer puts in variables that they don't want to go beyond. They will work that order flow and then do all their transactions with that. That's what the bank traders do. IPTA is pricing back to this level so they can do those types of things. Secondly, now we have all of this extended range. And it's a time range that distorts the model and it keeps people from seeing it. This is the part that took me forever to figure out. But once I got it, it was game, set, and match. No time frame eludes me now. Okay, so we have all of this price range in here. All right, so we have an order block here, and then we have an order block here, and then we have an order block here. We could be a seller here, a seller here, a seller here, a seller here. You see what I'm saying? Forget all that. Forget all that. Okay, this entire range here to here is skewed. It's completely skewed. There's actually two portions of price action in here. There's two distribution areas where the market goes up, the sell off, and goes down, goes up here, sells off, and then goes down again. But you cannot see it readily because of all this elongation, because of time. This is why I stress the fact that the time element, the chart, that's not the reason that makes the market go anywhere. Okay? IPTA will hold price in this window or range in price to facilitate trade. What do I mean by that? If we go and look at this little area right in here, this is the distribution area. Usually this would be like a red box in the market maker sell model. And then the other one is here. Oops. Might not have been able to get that the right way. We can get that. There you go. The other one's here. Okay. Now why is it this area right here? Why am I picking this little area right out? Of all this stuff, why is this and this the areas I'm focusing on? Because if you look at where we were in terms of the range, this is the range high here. And then we have the low right there. Okay, so this is our dealing range if we looked at just a 1 minute chart. Very, very disorienting. It's hard to make any sense out of that unless you know what you're looking for. So we have an area distribution here, and we have an area distribution here in terms of price range. Okay, distribution, distribution. So if we return up into this area like we do here, this is your sell. So you can see a distribution cycle, which is low risk sell, redistribution, and then once we come out of the bottom of that, right in here would be your second red box. So it's usually the gray box, a red box, and there might be another distribution cycle, and it would be here, and then it plunges down and clears the original consolidation and sell side liquidity. If you can see the price range, okay, that has been held in here, I don't care about all these candles. I'm not looking at what's an up close and down close. I'm looking at, we made the range high here, and the body of this candle is there at 22.82. So I'm watching when price breaks below that. It does so here on this candle. And then we return right back up into this distribution area. So what we have to do is completely ignore, and this is very tricky. I know it's going to be seeming like, oh, man, we just went way off the deep end. Now I don't know what I'm talking about. Or you don't know what I'm talking about, rather. Trust me, give me a moment, and I'm going to flesh it out a little bit more. But if we didn't have all of these candles, and we just had this portion of price action bump up to the bottom of this in this area here, it would look more like a standard market maker sell model. But because price has been held in this range on a 1 minute basis, every candle, price hasn't moved, price hasn't moved, price hasn't moved, price hasn't moved, price hasn't moved. I mean, it's moving very small, very micro fluctuations, but it's basically staying inside of a specific range. And the range is inside of these previous buy areas, and now they're mitigating and holding it and giving them a chance to get short, build their short position. The fact that we're looking at the element of time through the scope of 1 minute candles, it will skew the information. That's why generally 15-minute charts and 60-minute charts are much more refined in terms of like looking at the market maker sell models and buy models. Not that you can't see them like I've shown you here on this 1 minute chart, but you have to visually see what's going on. So the aspect of tape reading comes in like this. Smart money reversal here, low risk sell. Then we have a period of distribution. In other words, they look to sell more inside of the previous area of accumulation. So they bought long in here. It ran up, counterparty liquidity. They sell here to willing buyers, and they go short. Now here's a low risk sell. This is where people that understand this measure of trading, they can get in short, but they're missing on the really smart money entry. Then we wait for this move here, which returns back up into this area. There's your redistribution, or an area to sell short. And then you have that range. But I'm looking over here. So I'm monitoring how price is sitting in here. I'm not looking at up close candles to sell short at. I'm not looking for fair value gaps. I'm watching this range in here. Because in any time in this area here, I can get short. I'm not worried about trading back up into anything. I know I'm inside of the range to work with him because I'm over here in the previous area of accumulation of longs. So if we were able to take all of this information here out of the 1 minute chart, it would look like this. Okay. I took all that stuff and compressed it into a smaller one. So now you can see we have the original buy side, displacement, reaccumulation back to fair value and bullish order block. So this is reaccumulation of longs, runs up, reaccumulation of longs, smart money reversal, low risk sell, redistribution, sell off, run for the equal lows or sell side liquidity. So this is what it looks like when you have the market maker sell model and you look past all of the distortion. It's not that it's noise. Noise would be you have no idea what's going on. I know what I'm looking for, and it's just exactly what I just outlined here. You need to determine where the ranges are on the buy side of the curve and monitor how price is fluctuating through that. If we start breaking above the previous points of accumulation on the buy side of the curve, that means you do not have a sell model at all. It means you have an area where they're going to reaccumulate and go long. These areas on the buy side of the curve of a sell side model, they are your points of reference. You're not just staring into the abyss trying to figure out what's going on. You're looking specifically at predetermined price ranges, and even on a 1 minute basis, you can see how IPTA is respecting those previous ranges. It's not that IPTA is seeing 1 minute candles. It's not that. The 1 minute candle is just depicting what the range has been for that 1 minute interval. But time is a manipulative side of IPTA. You have to know what the dealing ranges are and the interbank order flow. Interbank order flow is what I just showed you right here. I'm cutting through all the BS of a 1 minute chart and getting right down to the nuts and bolts of what the order flow is on that level. Not order flow from an institutional standpoint because they can't see this way. I can, and it creates visibility. So if we know the draw on liquidity is here, anything up here like I just outlined here, okay, I didn't create or paint new candles. All I did was took what was existing, all this stuff out, and I just took this fractal here, scooted it over here, and there it is. It's done. I got rid of all this distortion. Now, you're photoshopping charts, and I'm confused, Michael. You're making stuff up. You're going to see lots of examples like this. That was the reason why I chose to start doing 1 minute charts, because I can show you with visibility, with proof that I can see what's going to happen before it happens, because I understand how to read the tape. When I tell you I'm reading the tape, I'm reading what IPTA is doing, what it's following. It has a macro that it's following. Certain procedures it has to do. The element of time, that is the variable that was the hardest for me, because that's the part that screws everybody up on retail. How long is this move going to take to get there? When will the move take place? How long will it take before it starts, and how long will it take before it finishes? That is a variable that took me a lot of time to master. That's the part that I just wasn't willing to sit in there and give to the world in free tutorials, because I watched and they're still doing it now. They're just completely, disrespecting the level of work that took to get this. It took a lot of work and patience and obedience, okay, to get this. And just to have people, throw it around and treating like they do, it's just disgusting. But nonetheless, I want you to understand that the 1 minute chart is not noise. There are periods of distortion, but there's perceptions that you can have only by referencing the previous areas of accumulation here of longs. Carry those levels over on the sell side of the curve, which is to the right of the smart money reversal. And you're going to need to watch this video several times. Okay, I know already you're like a deer in headlights listening. I have no idea what he's saying. I hope he makes it easier. It'll be easier by me showing you examples and examples and examples. Okay, just know that all of this stuff here and this noise that it would be called by anyone else is just them inside of a dealing range. IPTA does not price based on a time chart. It prices by way of time and price. So it's not the candlestick chart. It's not the time frame that creates the setups. It didn't say, oh, look at that order block on 15 minutes. That was the buy. That's not how this works. Okay, it's not how it works. It's time and price. Now, I'm not going to go out on a limb and tell you that I know every aspect of their time portion of the algorithm, because when I lose, that's the part I lose because of. It's not generally because I'm wrong on the direction. It's usually because my timing was off and I messed it up there. But as far as directional bias and seeing once they start spooling price and like here, I already know what's going to happen. I mean, and I can work within it. I put on a clinic in price action with a 1 minute chart this entire week, every single day. Friday of the previous week, Monday, Tuesday, Wednesday, Thursday, Friday. I did every single day, forecasted with annotations, proving beyond a shadow of a doubt that there's no noise on the lower time frames. The algorithm will distort these charts, not because it's hiding, because it's doing. It's not. In other words, it's not. I don't believe it's a mechanism that's creating like this. It's not like masking or cloaking what it's trying to do, because you can really clearly see what it's doing with the buy side of the curve on the left side of the curve. On the left side of the curve with the buy areas here. Every down close candle sets up the next move up. Those are your frame of reference. You just carry those over to the right side of the chart, and then it unlocks everything. What they bought here, they have to mitigate with going short. What they bought here, they have to mitigate and go short, targeting the liquidity over here. Don't spend that much time with all these candles, because the length of time it draws out, like for instance, if this would have been, like say it's a 30-second chart, man, this thing would be even longer. It would be twice as long. And if it's a 2-second chart, okay, whatever the interval you want to use, all of these candles would just be multiplied in the number of them before we saw this move here. So again, that's why I say the chart or the time frame is not the important factor. It's understanding the delivery of price, because once you understand what they're doing, they're running from this area here, pricing in up to the fair value gap. Once that fair value gap is tagged, they're selling short. They're adding more shorts, and then the displacement. And there's your weekly high. All of this builds with more examples, obviously, but nonetheless, tape reading, in the clearest definition I can provide for you, is understanding the ebb and flow of the micro dealing ranges that create as time goes by. The floor traders, they would always have a little pad in their hands. They would have their floor numbers, which is basically pivot numbers back then. And then what they would monitor was the intraday highs and lows. Every time they ticked up and made a new high for the day, they'd write that number down. And if it made another high 5 minutes later, they would write it down. So in their mind, they know what these ranges are, and they operate on that basis. They don't need a chart. I didn't need a chart back in the 90s. It was me looking at the CNBC ticker tape, and I would know, okay, we just made another higher high, and I knew what the previous day's high and low was. I knew where the previous day's close was. I knew what the previous day's open was. Why is that important? Because if I was working off a fair value gap, okay, I could see all that stuff based on just the price action ticking by every 10 minutes. And I didn't need to have a chart in front of me. And that's why I was confident to trade on the road while I was working, because I did not have charts. I just had numbers flashing on a little machine. It was a quote machine. That's all. It's like a little tiny little bit bigger than my Android phone now. And all it did was give me numbers, the high, the low, and where it was in the volume. That's it. That's all it was showing me, just that stuff. It wasn't giving me any charts. We didn't have the luxury of that stuff back then. It was just analog device showing me numbers, a range. And that's how I traded. So when I studied all of the things I was exposed to and filled in all the gaps with my retail understanding, it unlocked everything on a chart. So I can see inside this chart what would otherwise be confusing to anyone else. If I showed this chart to, I'm not going to go there. If I show it to anybody else that claims to read price action, they will not see the signatures that I'm showing you, because you have to be exposed to certain things, and then it unlocks. But you're not going to find it studying charts. You won't see it. You won't see it. That's why everybody out there walks around saying the same things. Intraday charts are just noise. I've never found anybody that can trade consistently on a 1 minute chart or an intraday chart. Well, I'm sitting here. I'm waving everybody. Hello. Here it is. It can be done. But you have to understand what you're doing, which takes a great deal of effort and takes a lot of concentration. And I already know this lesson probably feels like more confusion for you. That was kind of like what I was feeling when I first saw it, because I knew I was seeing something, but I couldn't quite figure it out. And once I understood and was exposed to how interbank is priced, that order flow, it became completely obvious. That side of the market, which is above institutional level. Okay, you have central bank above everybody. Then you have the large investment banks. That's your institutional guys. The Goldman Sachs boys, the UBS guys. They're under central bank. They're puppets on a string. Okay, they walk around with all the pomp and the clout chasing, and they're the big wigs, and we're the smart money. They're not the smart money. They're just puppets on a string from the central bank level. Anytime that central bank wants to smack them around, they can and they do. And beneath the institutional level is the smaller banks and insurance companies and larger traders. And then you get into the retail spectrum with brokerages and such, and it gets all the way down to the retail. So they're not, and it's not surprising when they say that when they look at intraday charts, it's just noise, because they've never been exposed to what I've been exposed to. And it's not a matter of arrogance, it's a matter of fact. When you speak to someone and they know something fluently, it's completely obvious, who knows what's going on. But in large trending models, Okay, large long-term trending models. The institutional guys, their stuff is good to follow because that's the dance. The central banks will be providing liquidity for those long-term moves. But at the turning points, they're going to be wrong. They don't have the luxury of working in these lower time frames. They're not permitted to look at these lower time frames. Their models are always on a daily and a weekly chart 90% of the time. 90% of the time. They're not allowed to use anything unless it's a trader that's exceptionally done well with their trading, and they've been like more or less special privileges have been granted to that person. Usually at an institutional level, you have a model that you just have to follow. They train you. This is what we look for. X, Y, Z. At this threshold, we put this much allocation of risk in, and there it is. You can't breach this level of risk. If you do, you got to kill it. And if you violate it as much as this much, then you're gone. And that's kind of like really minimizing it and oversimplifying it, but that's pretty much what it is. Interbank doesn't have that. This is the way it's going to be, like it or not. Market's going to do this, and there it is. If you didn't catch it, too bad. This is the truth of it all. So if we look at price and we remove all of the noise in here, okay, all the noise has been removed because we understand the ranges that price is working within relative to the left side of the curve, which is previous reaccumulation of longs, carry those ranges over. And then I'm watching how price moves in or out of that range. It's as simple as that. Now, watch what happens. The body of the candle, because that's the bulk of the volume in the reaccumulation of longs, because there's accumulation of longs down here you may not catch. This displacement, this is where you would have caught the long, or should have. And then rallies up, reaccumulation of new longs, rallies up here. This body, or the candle's body here, that close is the bottom of the range I'm looking for. When we break out of it, right there, okay, who cares what candle it does it in? I'm looking at the range. So when everybody else is watching these candles paint here, I'm staring at that. That's the bottom of the range. If that breaks away, and it does here, that creates what? Displacement. We've left this area of where it was previously reaccumulation of longs. They have done their dirty work. They have now established, or they should have already established, new shorts. This displacement creates what? An imbalance. There's your fair value gap. Here's the candle's high you want to reach above. You can sell short there and look for the liquidity resting below these equal lows, 10, 20, 15, whatever the pips value you have faith in, and it runs. The low here is 122.70. 10 pips below that would be 122.60. 122.59. It's only off by 1 pip on a 1 minute chart. That's supposed to be just noise. The market goes over here, creates a lower low. Low is 122.51. And again, just for completeness sake, the low is 70. So 20 pips would be what? 50 pips. I'm sorry, 122.50. And then the low forms at 122.51. It's only off by a pip for a 1 minute chart that's supposed to be just noise. You're gonna encounter a lot of people that are gonna not believe what you are learning, but they can't argue with the facts of me being able to do it. What I just showed you here was just a variable of what I did in Eurodollar. That's how I flipped and got myself in sync with the big move that just tanked it. This sell-off in here, I was watching the smaller ranges, and once the range broke, it created an imbalance right in here, and then created a small imbalance in here. But I wanted to see the range break, and then right in here, boop, sold short, and then I'm in here short, but it went up just a little bit more because I'm masking. I don't want people looking at what I'm doing and trying to figure it all out, because I'm convinced there's some smart people out there. I'm not the smartest person in the world, that's for sure. But that was what I did. I priced in what the expectation was relative with what I just said here, tape reading, and this little punch up in here got everybody excited, thinking it created a low, and then I said it right on the video and annotations. It's getting ready to go hard down. Like it was getting ready to break hard, and it's all based on the market maker sell model. So I already know that this lesson creates all kinds of questions, and that's good because that's what you want to learn. You want to learn, and the way you know you're learning is because you have barriers in understanding, and then they'll be filled in with more examples. Okay, but for now, just know that when I look at a 1 minute chart, I'm not confused by all this because I have specific frames of reference which you have already been taught in the core content. I'm just showing you how to apply them correctly. So until next time, wish good luck and good trading.